Hey everybody, Ashley Page here on our educational vlog. We're delighted as always you've joined us today. Our title is that the Chinese economy long-term impact will not be from tariffs. So we thought we would discuss that a little bit today, obviously because there's so much in the news about tariffs and your immediate reaction is, well, how could that be? There's so much being discussed about it. And you're correct. In the short term, we are going through a tariff and trade war issue right now, which will almost be a year old at the end of October. And we've seen the Federal Reserve lower interest rates slightly to deal with a manufacturing weakness over that. There was a lot of discussion about the trade war. There's a lot of discussions about the negotiations. But the point we wanted to make to you, as important as tariffs can be in the short term, they can be reversed like that. They can come on or come off just as quickly as the other way. So even though that is causing some short-term impact, and it certainly is in the manufacturing sector, we wanted to educate you today that there are two items that are much more important long-term really to what's happening with the Chinese economy as a trading partner. And let us tell you what they are. Number one, the larger long-term threat than the tariffs is that the amount that China has been importing from the United States in high-value machinery and equipment has been dropping steadily over the last 5 or 6 years. A great example would be, say, a CAT scanner for a hospital. The Chinese historically would not have the software expertise, they would not have the engineering expertise, they would not have the ability to manufacture it. And so they would buy a product like that from the United States. The first thing we want you to know is that the Chinese economy is becoming increasingly more sophisticated to build equipment, say like a CAT scanner or an airliner themselves. So before we even got into the tariff talk, this import percentage was already beginning to drop. The concerning thing too in the United States, even though as well as the absolute number going down, something like a CAT scanner, for example, is highly valued, high multiplier. So if somebody in the United States is making a CAT scanner, they've got a lot of suppliers helping with that. So that's the first thing, is that the import percentage of U.S. goods, and mainly high value add U.S. goods, is dropping. And that trend seems no sign of continue. That to us is going to have more long-term impact. That's first. The second one, like many other countries, the Chinese use public market institutional debt, if you will, like we do in the United States, to finance major infrastructure projects. We've been doing that forever in the United States. For them, they have really been on a breakneck pace with that, adding debt and buying infrastructure projects for the last 20 to 25 years because they've been trying to catch up on the world stage. They've pretty much done that now. So for example, if there were a lot of, say, debt structure that the central government was doing, let's say to build, as an example, a large bridge over a river at Shanghai, 5-10 years ago, you would see that project being worked on, and let's say you would see a major engineering firm in the United States doing all the design and engineering on that. Pretty much that debt financing of projects like that have stopped. So even though so it's a combination really of the two. It's the import of high value goods from the United States that have been steadily dropping, and it's also been the fact that they have been beginning really to level off their debt financing. And now that they've leveled off their debt financing, the world economy is not benefiting from that as much. Right after 2008, one of the things that did get the world economy through that is the Chinese were continuing to debt finance and still ordering a lot of engineering, services, and specialty projects from overseas. That's leveling off. So that's the point we wanted to make to you. Tariffs are certainly a part of it, and that's having an impact more in the short term, but the long-term factors are those two. The debt financing and the steady drop in imports of high-value goods from the United States. So long-term, that's going to have more impact on your portfolio and your money than the tariffs. So we hope this has been helpful. Please feel free to call us anytime if you want to discuss that further, or feel free to reach out to us on any social media platform, and we look forward to talking to you soon. Thanks.